I am Saitar Yilmaz of Çiftçi Attorney Partnership. And in this panel, we are going to discuss the outlook for capital markets and project bonds in the context of financing energy and infrastructure investments in Turkey. I'm very happy to be joined by our esteemed panelists today. Please welcome our speakers, Şule Kılıç, Deputy Head Turkey BRD, Sadık Çulcuoğlu, Managing Director, Head of Corporate Finance Yapı Kredi Yatırım, Onur Aksoy, Head of Debt and Equity Capital Markets, TSKB, and we will be joined by Ali Erdurmuş, Executive Vice Chair of the Capital Markets Board. So I will start my question with Şule Hanım. Şule Hanım, as the popularity of project bonds as an alternative method of financing infrastructure projects increases in Turkey in line with the global trends as usual, the approach to be taken by the IFIs becomes of a great interest to all market players. Historically, IFIs and in particular EBRD played a pivotal role in developing large-scale projects in Turkey. An example of this could be EBRD's involvement in Elazığ Healthcare PPP project, which marked the first greenfield infrastructure project bond in Turkey, or Mersin International Port bond refinancing. So how do you assess the current opportunities for cooperation with IFIs for raising funding for Turkish infrastructure projects through debt and debt capital markets? In which ways IFIs support Turkish corporates in tapping the bond market?
And thank you very much, Said Bey, for the introduction and entry question. I think it is a very important period of time as in Turkey we are experiencing, because compared with the previous years, what is really different now is that we are seeing a clear demand both on the demand side as well as on the supply side for the project bond and corporate bond markets. And this is not a surprise to us, I need to say. Probably you may recall in the previous events of EL events, I have mentioned a couple of times already that there are a number of projects which have completed their construction phase and they are already operational for a certain period of time, which would be very good for the project bond market or the corporate bond market to make the existing financings refinanced through the bond market. And that is what we are actually currently experiencing. Although we have a lot of negativities due to pandemic and uncertainties around the COVID crisis, and from the macroeconomic point of view, the economy is in general all around the world, not only in Turkey, are slowed down. But we are having, we have started seeing some light at the end of the tunnel, thanks to the vaccination program, which is implemented very widely all around the world, as well as in Turkey, in a very successful manner. I think this is helping with, of course, the macroeconomics going forward. And we have a very positive outlook for the Turkey, for example. Fitch just announced 6.3% growth rate, GDP growth rate for Turkey, which is really very promising. And considering the postponement of the demand and investments for quite some time already, I think this is not a surprise. So that's already bringing a very good picture for the bond market in general. That is why, not surprising, that we have seen some corporate bond issuances in the last 6 months, starting with the Pegasus, and then followed by the Arçelik and the Zorlu Enerji. Although those projects were really more in the form of corporate bond with the tenure of 5 to 7 years. And we have seen one good example of Iskenderun Port project with a 15-year tenure, which I can say that it is a typical project bond. And the proceeds were mainly used for the refinancing of the existing project finance loans as well as the CAPEX. So in the past, as you may recall, there was a Mersin Port bond issued, which happened twice, actually, 2 bond issuances. And we have, as EBRD, we have participated in the both of them as anchor investor. And those were more like a kind of mixture of corporate and project bond, I should say. And Elazığ bond was really a very typical project bond, although the structure was quite complicated. When I look at going forward, what we would expect, and actually it would not be really surprised to see many projects who have already completed their construction process to go to the bond market and make a bond issue in order to refinance existing loans and make the new capex investments through that, and also relieve in a way the existing bank limits for the other new greenfield projects. Why I'm saying this, because you know that actually bond issue has negative carry for the greenfield projects because of the construction period, especially for the infrastructure projects, and generally quite most of the bond investors do not really like the construction risk. That was one of the reasons during the Elazığ PPP project that we have provided a kind of liquidity facility for the construction period of time, in order to make sure that the bondholders still are being serviced, even if it is a construction period. So going forward, when I look at the pipeline, we see a large number of PPP hospital projects, which have already started operations, for example, and they are generally 15 to 18-year tenure projects. There is availability-based structures, which means the revenues are quite stable, and as you know, there is some FX protection as well for the revenue base, and there is also some Ministry of Health involvement in those projects by providing the termination compensation mechanism as well as the availability payment guarantee. So this is a very good, for example, project for the project bond issuances, and I'm hoping that we would see the PPP hospital projects which are already operating in the bond market. Also, other infrastructure projects, or there are large energy companies with a pool of renewable energy projects, which may be very good candidate for the green bond issue, which we started hearing a lot, especially in the last 1 year. I think the green and how to certify a bond green become more clear in the meanwhile, although this was discussed quite some time already. Now there is, I think, certain streamlined process in order to classify or certify a bond, a green bond. So that's why we should not be surprised to see many green bond issuances coming forward. Coming to the EBRD's role or IFI's role in this picture, one of the unfortunate things, as you know, is Turkey is still below investment grade. So any project in Turkey, unfortunately, when it is rated, it is stuck with the country ceiling. So that's why we have been having certain, of course, problems to attract institutional investors can only invest the investment grade bonds. So one of the areas which we are aiming to get more active is the credit enhancement tool, which we are trying to still use and develop further, as we have done in Elazığ PPP. In order to help the bond issuances to get an investment grade higher than, to get a rating closer to the investment grade, so that we can attract more investors into these bond issuances. Of course, anchor investor role is a typical role which we can also get involved, and based on our capital market internal rules, we are able to invest up to 20% of the total bond issuances as an anchor investor, but it very much depends on the structure and transition impact related angles of the bond as well, because, you know, being a development bank, for us, it's not just that the bond issue or the financing which is important, but all the transactional and transitional impact angles like green, like gender, and corporate governance angles, which are very important to be attached to the bond together with it, so that it helps for the project and the company to improve its internal corporate governance and regulations and approach to the green and climate change. So that's where we want to further enhance with our involvement in the projects that we become an anchor investor by supporting those companies and bond issuances with those kind of policy angles attached to the bonds. So, of course, we should see other IFIs also getting probably active in the credit enhancement side or anchor investment side. And we realize that involvement of IFIs, especially in the long tenor project bonds, will be very important also going forward. And maybe I should stop here, but
thank you very much. No, I mean, it's all very clear from my perspective, and thank you very much for the giving us the insight of EBRD's in particular role, that how to support the capital markets in Turkey with exemplifying it. I mean, but as you mentioned, my second question again to you, just a follow-up one. As you mentioned, there are only a few of them, unfortunately, with respect to project bonds in Turkey. There are some areas, as again you mentioned, like the healthcare PPP project or big energy projects, but these are still being tested. So in your view, what are the main challenges for corporates planning to fund their infrastructure investments through the project bonds?
I mean, of course, the most important challenge is the uncertainty and macroeconomic stability of Turkey, because any project being in Turkey, the first thing the investors look at is whether there is certain foreseeability and whether some stability.
All right. Just moving forward on this one, Şule Hanım already touched upon on these difficulties as well. Like if when there's a green field investment, there's a construction risk, and therefore there might be also a negative carry issue, and you need other enhancement mechanism in order for corporates to tap those markets. So I think I can move on the next one. Ali Bey, welcome back again. And
thank you so much. Sorry for the technical problem.
No problem at all. I think, as I said, there is some sort of a difficulty on this project bonds, but nevertheless, we are going to achieve it. With Turkey's new project bond legislation aiming to promote the participation of a wider range of investors and various incentives seeking to attract foreign and local debt investors to infrastructure projects, Turkey's investor base of project bond is expected to broaden and grow. So in your view, which policy actions have proven to be successful in the past, and what does the future hold for Turkish project bonds?
Thank you so much. I am very happy to attend this event and believe that it will provide a productive discussion environment. As you know, Turkey takes one of the leading role in the global capital projects and infrastructure spending, with many significant projects among the developing countries. More than $100 billion has been spent in last 5 years for these projects, most of which are solely for mega-sized projects such as Istanbul Third Airport and Third Bosphorus Bridge. So the expected amount of investments for the projects is to reach more than 300 billion Turkish liras until 2023, which is the centenary of the Turkish Republic. But when we look at the financing structure of those kind of projects, usually the financing needs of these projects are both served by Turkish banks and international financial institutions. In consideration the significant size of planned investments in Turkey, the Turkish government is actively supporting the involvement of the private sector in the infrastructure market through different PPP structures, rather than just relying on traditional public procurements. So I think this is one of the main reasons for successful implementation of infrastructure investments in Turkey. There is a strong political support, and relying on private sector with new structures and models rather than using traditional structures proved to be successful in the past. As you know, public-private partnerships are a mechanism for government to procure and implement public infrastructure or services using the resources and expertise of private sector, where governments are facing aging or lack of infrastructure and require more efficient services. A partnership with private sector can help foster new solutions and bring finance to these kind of investments. So that also when you look at the last 2 years, there are more than 200 projects which capital cost more than $68 million in multiple sectors. When we look at these projects, we see that transportations are the basic sector, which is the largest single component of these projects, accounting for nearly 60% of those total infrastructure lending. Also, energy and health sectors each represented about approximately 20 and 23% of lending to infrastructure. Also, many of you know that recently, Ministry of Energy also successfully completed renewable energy licenses for these private companies. When you consider these huge size of expected investments in the following years, so that Turkish infrastructure market will require significant amount of external funds to realize those planned projects. Currently, the main driver of the financing of these projects in Turkey is local commercial banks for debt financing and local investors on the equity side for private sector and investments and PPP projects. When you look at the bank loans for project finance, we see that infrastructure lending accounted for approximately 15% of total banking assets. On the other hand, the supply of bankable projects is shrinking. Also, the implementation of the Basel III regulations requires stricter rules, ultimately leading to the higher cost and higher capital requirements. These higher costs will be passed through to the project developers, which will translate to the diminishing project IRRs. So that by accessing, in addition to these, infrastructure investments are attractive to the institutional investors, such as pension funds, as they can assist with liability-driven investments and provide duration hedging. Infrastructure projects are long-term investments that could match the long duration of pension fund liabilities. So that pension funds are increasingly looking at these kind of infrastructure investments to diversify their portfolios due to the low correlation of these investments with the traditional asset classes. So that we believe that also with the 180 billion Turkish lira savings in the private pension systems of Turkey, which is constitutes an alternative local institutional investor base for these kind of investments. But we also consider that these are not enough, those kind of huge infrastructure investments. So that we believe that main investment alternative for these kind of investments, all these investments can be financed through the capital markets, which is the main platform for the long-term funding. But as Şule Hanım said, that except a few limited examples of the capital markets projects like corporate bonds, and I remember a small part of private equity funds was used, one of the city hospital projects. So we have seen limited use of capital markets products in these kind of projects. So that also these current conditions of the banking sector in Turkey also requires to use new capital market solutions to solve these kind of problems in the infrastructure investment environment. Within this context, last year, capital markets law has been amended to include and to introduce these project bonds to the capital markets. As CMB, we have drafted a secondary regulation with the help of all related stakeholders, and the communique about project bonds is about to publish in official gazette very soon. We have completed all necessary works in terms of our regulator perspective, so that project bonds regulations also, maybe you know, that is one of the main components of the economic reform action plan of the Turkish government. Okay, what will provide these kind of these new products to the infrastructure investment environment? We believe that these kind of funds, people, you can with these new regulations, we aim to enable financing of the large-scale projects such as infrastructure, energy, health, transportation technology, and similar long-term project assets through the issuance of the project bonds by project finance funds. Basically, this is out of balance sheet securitization approach. There will be a project finance fund, and there will be project-based securities. The law establishes project finance funds, which will manage a portfolio of funds or other assets within the scope of specific project in the name of the project bond holders. Project bonds are to be issued by these project finance funds to the investors whose investment will be effectively tied to the return on assets in the project finance funds. Only investment firms authorized by CMB and the banks may establish these kind of funds. The assets, one of the main important of our regulation is that the assets of these funds are segregated from the investment firm establishing such funds, and therefore risk related to the insolvency of such investment firm don't impact the fund assets. Along with the cash flow of these projects, the project loans of investment firms and the banks can be backed by the project bonds, which creates, we believe, that an opportunity for the banks to liquidate their assets and generate revenue. Because in our regulation, there are two methods for the project finance bonds. One of them is refinancing. Bank loans and some project, for example, completed their construction phase and started to operate, and there is a stable cash flow, so that if banks wants to deleverage its loans, so they can set up a project funds and they can collect the necessary money from the capital market investors. So this is an important aspect. We believe that also we expect the first examples of these new product will come from the refinancing side, because as Juliano said, it is not favorable conditions currently in Turkey. We don't expect greenfield project finance, which is also possible according to our regulations. You can collect money and you can put that money in an escrow account, and you can use that money to complete the construction phase of new projects. So we believe that this is an important aspect. Also, you know that long-term investments require demand from domestic and foreign investors. We also aware that Turkish Turkish domestic investor base will not be enough for these kind of investments. We also believe that institutional investor size, especially pension funds, may have interest on investing these kind of project bonds. We also believe that after initial implementation, we can make some fine-tuning and we can provide some kind of incentives. For example, there is an fee incentives. At the end of 2020 years, we will not take any regulatory fees, these kind of bonds issuances.
Thank you. Thank you very much, Ali Bey. It's quite a broader summary, and thank you very much for the legislation, explaining the legislation aspect of it. I mean, everybody was waiting for, obviously, for in and outside Turkey investors for the project bonds, and the ring fence mechanism is a standard where, you know, in line with the international one. So, but as you mentioned, I mean, my question to Sadık Bey, in light of the increasing banking regulations and tighter capital adequacy requirements and the limits on exposure to certain countries and sectors in accordance with the various global developments, investors are looking into more alternative methods to manage their liabilities. I mean, in this context, structured onshore and cross-border bond issues are attracting more and more issuers, investors, against the backdrop of the COVID-19 related credit crunch on a global scale. In your view, what will be the role of private sector and municipal debt issuances in infrastructure financing in the coming years? Which types of regulatory or financial incentives could help boost investments in Turkish project bonds?
Thank you.
Thank you, Said. Ali Bey has already mentioned, actually, with the introduction of Basel III regulatory reforms, long tenor project financing become less interesting for banks worldwide. So banks tend to switch shorter term financing structures, whereby loans are provided to borrowers targeting a 5 to 7 year sort of horizon. We observe that infra investors tend to fill in this gap for longer tenor funding in markets with established infra investor base. And infra investors also take part in more junior part of capital structure in mezz or junior debt type of structures which aren't interesting for banks. So this is sort of the overall scene in European market. And when we come to Turkey, on the supply side, Turkey continues to have significant investment targets in infra development, from transportation to healthcare and energy. As we talk during this forum, there is an ample pipeline, and according to Presidency's investment office, around 20-25 billion annual, or even probably more, expected to be invested over a 10-year period. And as again Ali Bey has mentioned, there is also an existing loans that could come to the market as a refinancing option. So on the supply side, basically, there is a lot of opportunities, and the pipeline is really rich. So it's really important for us, in addition to the bank market, we have a really feasible capital markets so that they will be able to absorb this much supply. So it's not a supply issue overall. But on the demand side, I think for project bonds, what Turkey lacks is not regulations, not incentives, but rather an investor base willing to invest long-term structured instruments. So we need to attract European infra investors into Turkey. Currently, they decline most of the opportunities just because they're outside of their mandates. They're typically only interested within the EU, or they don't invest at non-investment grade countries for infra-specific funds mostly. But they have ample liquidity, and they don't find enough opportunities to invest. Nonetheless, they can still invest in Turkish projects, but it's basically there are some restrictions. So in this environment, it's important for us to establish a local investor base for infra financing, as it generates a very predictable and stable cash flow over the long term, and it matches insurance liabilities. That's, I think, one part we're really missing, again, in our capital markets on the local front. We are mostly pension funds are here on the front row when it comes to capital market participation. But again, it's, I think, in the economic reform action plan that insurance industry is expected to play a more active role here, as in European cases, and be pioneer investors and support the development of this market. So I think as we find, and also there are obviously some macro issues, as again Shulan mentioned, about stability and other macro concerns that some of European investors are a little bit hesitant about. But I think as we broaden the investor base with more domestic investors, and Turkish lira becomes a bit more stable, and maybe the level of interest rates also is important. I think when it comes to lira financing come down, I think we'll have, when we have both local and international investor base at the same time, I think we'll have a more liquid market. And also, I think one thing also I would like to add is, as you know, our market is a bit segregated. We have Turkish lira denominated market, largely invested by Turkish accounts, and also offshore market only in dollars, and basically when it comes to hard currency financing, you need to go to offshore market. So I think maybe for some projects, if we are allowed to have Turkish investors invest in USD denominated instruments, particularly for infra related, where there is a public benefit as well, I think that could be a step in bringing these two liquidity pool together, both international and local, to the deals.
Thank you, Sadık Bey. I mean, moving to Onur Bey, our panelists already touched upon these shortly, but I think I just want to ask you the question now here. So basically, project bond is a different animal, what we've seen in the market, as it's historically been dominated by the bank loans. Like, I mean, it's a different from a disclosure perspective, and it's different from like how the bonds proceeds will be used or how the proceeds will be received. So from your perspective, experience, how are Turkish project investors and corporate issuers doing in terms of overcoming the barriers, and all things considered, what are the main driving factors of corporates to take this less tested route? Onur Bey, I think you're on mute.
Excuse me. Thank you. I believe that taking this less tested route is no longer completely a matter of choice, and we will see more project bond issuances in the near future. Because Turkish companies have an extensive need for funding for infra and energy projects. And because of increasing banking regulations, banks can no longer single-handedly meet the financing needs of sizable infra and energy projects. Given the capital adequacy requirements applicable to banks and the limits on exposure to certain countries, areas, sectors, the financing needs of investors may not be met through conventional methods of funding. This is especially the case for Turkey, where multiple large-sized infrastructure projects are developed at the same time. To overcome this funding gap, investors have to find ways of mobilizing alternative forms of financing. One of these alternative forms of financing is, of course, project bonds. Project bonds differ from regular corporate bonds in that they are issued to finance a specific project, and the bond proceeds are paid exclusively from the cash flow generated by that project, as opposed to the overall revenue of the issuing corporation. This means that project bonds are long-term investments, especially when issued to fund greenfield projects involving an extensive construction phase. As a result of this, project bonds are particularly attractive for capital markets investors looking for stable and long-term investment opportunities. However, as you have stated, project bonds carry some features which may not necessarily look suitable for some investors, actually. A major turn-off, I would say turn-off, from the issuer's perspective would be, especially when it comes to greenfield projects, is the issue of negative carry. The concern here is that the issuer receives the funds at once and upfront at closing, whereas the capital expenditure costs spread over a construction period lasting several years. During this period, the issuer is required to pay interest on the amounts that are neither needed nor used. A solution for this would be structure a tailor-made draw mechanism, but if it's doable, of course. Another reason why a company may prefer debt financing over bond financing may be that the company has limited access to capital markets due to the size of its business or its financial situation, or because of confidentiality concerns. However, I believe these are not likely significant concerns for Turkish companies taking on major infra and energy projects, which require a sizable investment by nature. On the other hand, as I have stated previously, traditional financing may not always be available due to capital adequacy requirements and exposure limits of banks, which may lead companies who are facing such issues to turn towards bond financing. There are many benefits associated to financing through project bonds. Project bonds allows issuers to stabilize their financing costs for the lifespan of the project, and project bond covenants are usually less strict compared to the covenants undertaken for debt financing. A recent example, the Limakport project bond deal has a tenor of 15 years, and I believe that this is a tenor that would be not possible to reach through any of the conventional financing methods under current market circumstances. The Elazığ Hospital and Limak Port issuances have shown that Turkish project developers are willing to finance their investments through project bonds. Let's just hope that project developers will be able to utilize this alternative source of funding directly in Turkish capital markets in near future. Sadık, I believe you had some thoughts on this.
Yeah, just a couple points I would like to add here. Onur is absolutely right about the negative carry, but a recent trend in European markets, we see increasingly sort of deferred drawdown mechanisms for infra investors as well. So they wait like 18 to 36 month period to invest. This is a good development. That's point number one. And for a second point, also when it comes to transparency, again, given this is the infra bonds is a very specific asset class with its own investor base, basically. European investors typically don't even require rating. Only US investors require rating, so they do their own rating work. And typically, they are okay with private placements. Sometimes for tax reasons, they might require some listing. There is not really much information given to public, basically. So these are all private placements. Again, of course, there'll be some transparency, but it's not going to be like a public issuance when we access as Turkish corporates have access to this investor base.
Thank you, Sadık Bey. On this one, as you said, that there are some kind of less disclosure requirement when it's regas compared to one portfolio where we are seeking for US qualified investors in a way. But then again, there will be some, at least minimal transparency requirements, which would be, I think, useful for everyone
Sure.
in any event. And moving to Ali Bey on this one, I mean, 2020 and 2021 have so far been certainly very active and exciting years in the Turkish debt and equity capital markets in terms of transaction volumes and investor numbers, which also manifests through a boom in both IPOs and both issuance by Turkish issuers, corporates. Building on this momentum, in your view, in which ways could infrastructure investors, issues could make the best use of the debt and equity capital markets to tap more liquidity into their projects?
Thank you. As you said, we have seen an unexpected increase in both investors and companies' appetite in capital markets after COVID-19 pandemic. With the help of favorable economic conditions, especially retail investors rediscovered the potential of capital markets, so that the number of investors in BIST has exceeded 2 million, and the volume of IPOs with more than currently 11 billion Turkish liras has exceeded the volume of IPOs those for the last 4 years. When you look at the current IPOs, we have seen that 6 of those 20 IPOs successfully closed this year are related with the infrastructure investments like renewable energy companies and utility companies. So that first, I want to mention that infrastructure investors and companies could make use of these favorable conditions for IPOs, and we have seen some companies use their IPO proceedings to pay their bank loans and to some extent decrease their liabilities to achieve a healthy financing mix with the help of the equity financing. So they can make use of equity side of capital markets to have a healthy balance sheet for the companies. From the debt capital market side, they can issue corporate bonds in abroad and make use of favorable low interest rates conditions. But there are some limitations to issue corporate bonds domestically for hard currencies. As you know, Turkish regulations won't allow currently issuing corporate bonds in dollar denominated Turkish. So that maybe, I don't know, after our new communique put into place, maybe we can discuss these kind of conditions, and we should get the political support of government. But because of, as Sadık Bey mentioned, that there's a dollarization process, so that probably government will not look at, will not be ready to accept this kind of incentive mechanism, I guess. But also, we have seen in our past experiences show that there were limited use of corporate bonds financing needs of infrastructure investments. maybe I should also mention that rather than corporate bonds, lease certificates, which is known as sukuks, are a potential source of financing those kind of companies. So that also one of the, as I mentioned before, infrastructure, these project developers can make use of private equity fund structures to fund their infrastructure investments. And finally, these project bonds are good alternative for banks and investment firms to create fund and liquidate their existing project loans by allowing securitization via an SPV. Securitization allows banks and investment firms to pool individual loan and sell them onto project bond market as securities. Issuers may raise equity and debt financing through private market channels, through direct or direct investment by large institutional investors. Maybe I should say that, as Ms. Onur Bey said, that our regulations will not allow to give all the money from funds to the project developers. We have a mechanism that according to, we require a feasibility report, and according to the construction phases, we will make use, project developers will use money partially. They will not be able to take whole money from the project finance funds initially for the greenfield infrastructure investments. So it is a little bit secure mechanism, I guess. Also, as I mentioned before, refinancing method will provide demand side, will alleviate the constraints for the demand side, because you don't have grace periods, and you will have, when you enter this kind of project bonds, when you invest this kind of project bonds, you will have constant cash flow, so you don't have the construction phase. So it will be probably completed and projects started to operate. So that we believe that both equity side and debt side can be utilized by these kind of investments.
Thank you very much, Ali Bey. I mean, it's quite important, as you mentioned, like maybe it is not going to happen in the near future, but for a long term, it would be, I think, good to consider whether, not from a dollarization perspective, foreign currency issuances may be available to the Turkish investors as well, given the size of some of the projects and how structured they are. I mean, it may also be, a good thing for the Turkish investors to tap into those kind of structure. And as you mentioned, and the legislation itself, it creates a novel structure where, in case of when there's a milestone has been reached in terms of the green financing projects, then the payment is going to be made, and so it also provides a certain level of comfort to the stakeholders of the project. So I mean, Sadık Bey, we discussed this like every single panel regarding the ESG, obviously the infamous one. It touches on, I mean, it's related to everything. So I mean, banks are dedicating increasingly significant resources to financing sustainable assets and expanding their availability to invest, advise, and innovate in this area, both on global and local scale. And for instance, a number of prominent Turkish banks, including Yapı Kredi, have designed the Declaration on Sustainable Finance. And moreover, Yapı Kredi recently announced that it will no longer finance coal-fired power plants. So how are the markets reacting to these developments? And in your view, what would be the impact of these types on Turkish infrastructure financing market?
Thank you. Yes, I mean, as we all know, according to World Risk Report of World Economic Forum, 4 of the 5 major risk factors are environment or climate related. So as banks are in the middle of risk management business or risk distribution business, basically they can't ignore these facts, and they are internalizing these themes to their procedures and credit policies. And as you mentioned, Yapı Kredi Bank has also initiated these programs. As you mentioned again, not participating to coal investments, and basically putting ESG concepts at the core of its credit policies. Obviously, this is a program, and there are goals, but they are part of the policies of the bank, as many other banks globally doing the same. But I think when you look at the Turkish context, this is even more important because for all three parts of ESG, like environmental, social, and governance parts, as a developing country, we also trying to match some of the developed nations. And for instance, when it comes to women's participation to workforce, for instance, this comes into play, and some banks in Turkey utilize some of the loans that they've received from international markets towards this specific use. So these are the economic benefits basically are there. There are now ample liquidity, only looking to allocate funds dedicated towards this type of uses. So banks trying to, for economical reasons, banks trying to basically access these funds and finding ways to basically spend. So to answer your question, yes, I mean, market from a that standpoint, market is guiding banks to take further actions in this front. But also, I think because it's not just banks' own financing, banks also advise clients to do so. As Yapı Kredi Bank, again, we are doing this. As Turkey is basically trading, for the large part, trading with European nations, this is also important for our Turkish corporates to be aware of these concepts, the European Green Deal, for instance, and have policies, procedures, and business models complying with these universal standards, basically. So as banks, we are also trying to train our clients and to adapt their business models accordingly. Again, these are also sustainability targets for banks. When we do this, we also get some credit, and this helps with our borrowings, external borrowings, syndications, because there are independent agencies, and they basically record these initiatives. So as a bank, you get benefit of it, and your corporate client, gets a long-term benefit by adapting to these standards so that they have a sustainable business going forward. So it really is a sort of a circular theme, and I think markets are guiding banks toward this direction.
Thank you very much, Sadık Bey. I mean, Onur Bey, I mean, your bank is also one of the prominent banks on the green finance and ESG, and we work, recently together on the TSKB's green bond issuance. So, in your view, could the use of sustainable and green bonds for the financing of energy and infrastructure projects be useful to attract new investors? What steps could be taken to attract ESG investors to the Turkish project bond market?
Thank you. The use of sustainable and green bonds will definitely attract new investors. Sustainable investing has gained significant traction in recent years as a way for companies to exhibit corporate social responsibility in the community by meeting a wide range of ESG targets. Increasingly, issuers are also finding they are being financially rewarded for such investing strategies, claiming pricing advantages. ESG bonds, which is an umbrella term that captures green bonds, social bonds, sustainable development bonds, are capital raising initiatives used for reaching these targets. Over the past 5 years, the number of corporate green bond issuances continues to grow as both public and private issuers try to demonstrate increased environmental and social consciousness to their investors. The recent Limakport project bond issuance has also an ESG-related feature. A step-up coupon based on environmental, social, and governance key performance indicators. They have made a commitment to replace all fuel vehicles to electric vehicles over the next 7 years. And I have been informed that ESG investors comprise a significant portion in total demand, so they have been some kind of rewarded for their commitment. The Elazığ Hastanesi issuance was also a green and social bond. So far, both project bond examples out of Turkey are ESG related. The ESG assets under management level is increasing, and it would be very useful to structure sustainable instruments to attract a wider investor base. According to current estimates, with an assumption of 15% annual growth, which is half the pace of the past 5 years, ESG assets under management could climb to more than a third of the projected $140 trillion global total by 2025. Let me also briefly express my experience on the benefits of ESG-related issuances, as TSKB issued the first green sustainable bond in Turkey and out of the EMEA region in 2016, which was followed by the first subordinated sustainable bond issuance in the world in 2017. We have issued an additional sustainable bond at the beginning of this year. We have arranged for our clients the first sustainable sukuk and the first sukuk according to UN Sustainable Development Goals in 2020 and 2021 respectively. We have seen huge investor demand in all of our deals, and Turkish asset managers are currently establishing ESG-related funds, which will enable us to arrange ESG-related issuances also in Turkish markets. I believe that project bonds issued out of Turkey can see a much better demand if they have an ESG component. So if the project is eligible for labeling as sustainable and green, then I would definitely advise issuers to have the deals structured accordingly and attract also ESG investors. Thank you.
Thank you very much, Onur Bey. Thank you, everyone. I would like to thank each of our panelists on their insightful contributions. We discussed the challenges, opportunities, and from a regulatory perspective, from a market perspective as well. I think it was a very, very fruitful session. I think what we need right now is a pioneer Turkish corporates who are willing to test these waters, and we are going to see more and more on the project bond side. Thank you very much, everyone, for your time.
Thank you.